Welcome everyone to another episode of Wolfe Street. For those of you that don't know, my name is Wolfe, and for those of you that do, what's up? Thanks for checking me out again. As always, you can check me out on social media at EveryTimeICash. That's at EveryTimeICash. No weird symbols, no numbers, no spaces, no punctuation. Just at EveryTimeICash. Or if you want to make things more intimate, reach out to me directly at everytimeicash.com/contact. That's everytimeicash.com/contact. Shout out to the doofus last week that thought there was an @ symbol in my website. There's no @ symbol, dude. Sorry for throwing you under the bus, but it was funny. It's just everytimeicash.com/contact. This video and all videos on my YouTube and all content for that matter that I put out is intended for informational, educational, sort of, and most importantly, entertainment purposes only. Yeah, I know it's kind of boring entertainment, but it's entertainment nonetheless. It's not financial advice. I'm not a financial advisor. I'm not pretending to be a financial advisor. If you need help, please seek the help of a financial professional in your area, or not, just a financial professional will do, and build out a plan that best suits your needs. Please don't take financial advice from random weirdos on the internet like me, or lie to yourself and say that they're giving you financial advice, because I'm telling you I'm not. So get some help, get a financial professional, build out a plan that best suits your needs, and don't end up in divorce court. So this video, without further ado, is a follow-up to the video that I put out last week. This is just going to be like a little bolt-on. It's going to be a very quick video. So if you haven't seen last week's video, there should be a pop-up on your screen here on YouTube. Click that link, go back, watch the previous video, and it'll give you a better input, better insight for what it is that I'm talking about. It'll give you a lot more context, and it's going to be best absorbed if you did check out that video. So hopefully you watched that video, and if you haven't, go back and see it. Also, before I get started, if you haven't, please subscribe to the channel if you find it useful. Please click the thumbs up link, or thumbs up rather, if you found it useful. Thumbs down if you didn't find it useful. Please leave me a comment in the comment section below, letting me know what it is you found useful or what it is you didn't find useful. That gives me a little bit of input so that I can best use my time adequately and so I don't waste your time. So yeah, I gave you a bunch of rambling up at the top, but I'm going to just go ahead and jump right into it. Again, this video is a follow-up to last week's video, and without further ado, let's just jump right into it. So last week, we closed out the month of August with the 7th consecutive up month for the markets. So there have been a number of times, I'm going to get into it on the next slide, but there have been a number of times where this has happened. August was the most recent time that this happened. And as I said last week, history typically says that this is a bullish event going into the end of the year. So this is not a situation where we want to be reluctant going into year end. However, this is a situation where we want to be tactical and not press our bets every single time, right? So let's just take a look at the market in general, where we stand. So this is NASDAQ. This is NASDAQ futures. You'll remember this chart from last week. And despite the fact that we saw some positive gains to end the week last week, we really didn't go anywhere. So if I just zoom in here, we're consolidating, we're pressed up against this resistance band that we've had, for the better part of a year and a half, for a better part of a year. We're pressed right up against that resistance. There is a potential that we roll over or we could blast through. I talked about it in the last video. Please go back and watch it if you haven't. Now, if we just take a look at the S&P, again, we consolidated, we got to that inflection point. We really haven't gone anywhere. And then again, I'm just going to zoom out so that we can cover very briefly that channel that we talked about last week in the video. So pressed up against the top of this channel, haven't broken through, haven't been able to break through. Who knows if we will, but that's a pretty good setup going into this video. So yeah, like I said, we closed the month of August for the 7th consecutive month. This is typically a good sign, but it's not a press your bet sign. Historically, since the S&P became a 500 stock index in 1957, we have had 13 other months that the S&P 500 closed up 7 months. 13 different times that we closed up 7 or more months. So this time we'll make number 14. From that, we can make the following observations. So the S&P continued to at least 8 months consecutively, 38% of the time. So 5 out of the 13 times we stopped. Excuse me, I said that wrong. So the streak ended 7 months, 38% of the time. Sorry, misspoke. The streak ended at 7 months, 38% of the time. That's 5 out of 13 months. Only 2 instances saw drawdowns at some point following the close of the 7 month. So we could have bought the market at a discount 85% of the time. So this is just a barometer telling us that, typically when we get to the 7th month, we find ourselves pressing up into a little bit of resistance, and we find ourselves pressing up into a pause situation. So if I just show this to you on the next slide, here are the streaks. These are the 14 times. You'll notice that the 14th time at the bottom here is the most recent time. You'll also notice that there are a litany of different periods that happened, and the most recent one to record was 2017. Now, 2017 is interesting because, let's go back and see, because if we remember in 2017, we ran up, and then we had that, where we at? So we ran up and we had that early sell-off in 2018, and then we had the end of the year sell-off in 2018. So 2017 is an interesting staple because it's the most recent one, but also because we really had that escape velocity blow-off into February, and then we found ourselves back up to it and then rolled over into year end of 2018. So it's an important footnote that I want to mention there, just to kind of keep in the back of our heads. Now I'm going to pull up all of the instances that we've seen 7 months or more on this nice little graph. So let me see if I can make this bigger. Yes, I can. So this is a graph courtesy of Canaccord, Genuity, and Dwyer strategy. This is going to give us every data set of these 13 other instances. There's a couple things I want to pull from this. Now, the max drawdown between the 7th month and 6 months out historically is right here on our screen, right? So the max sell-off from the 7th month, over to 6 months out from that point was 6.35%. So this tells you that historically, whenever you see this kind of action, you might get a sell-off, but historically it hasn't shown a material sell-off in any of these events in previous history. So we go into September, which is a seasonally weak month. We're pressed up against resistance. There is a potential that we see a sell-off, but the whole point of sharing this and the whole point of all of this is to suggest that we could get a sell-off. Historically, it has never been very material, hasn't been cataclysmic in any way, shape, or form. And then the second point is from that 7th month and to the next 6 months out, these are the historical returns for the S&P 500. On average, we've seen 9.7%, and the median return is about 10.8%. So it's basically telling you that some point after the 7th month, you'll see a little bit of a correction. That little correction, it's a minor correction. It's like more of a blip. Historically, is about 3%. And then that return 6 months out, including this little 3% blip, has been an average of basically 10% return. Now, if I just pull out this 1996 moment where we had a 6.35% sell-off, that was the extreme. Followed up with 13% return. So again, this is just to kind of give us a little bit of a barometer of what could happen. It's not saying this is what will happen. Obviously, history a lot of times will rhyme, but doesn't necessarily repeat. But this is just a nice little barometer. This is just mathematically telling me that if I have 13 other instances like this one, and then historically there's no real sell-off after this happens, and then historically every instance, every single one that's happened like this has finished higher 6 months out, that's a pretty good tell for me to just kind of be, a little bit cautiously optimistic. So if we just put some numbers to this, right? So currently we're sitting at 45.50. We just put some numbers to this, so on a nice little sell-off, we'll find ourselves, minus in the worst case percent, we'll find ourselves down to the 100-day. That's not much, right? So in the worst case, typically what we've been seeing is we sell off to that 50-day rally back. But should we get to, let's say in this case, we get to this 100-day, right? So it's not even like a material thing. We get down to the 100-day, excuse me, that'll just be 250 points on the S&P. That's nothing, right? So that falls in line. Go back to this chart, that falls in line with these averages that we have. It actually comes out less than the 6.35% that we saw. And, business as usual. The S&P 500 can give back, 5% in this instance, give or take. And we'll find ourselves at the 100-day. Business as usual. Keep it moving. Let's see where we go. The other thing that I want to point out on this chart here is, on average, the number of days that we've seen these corrections have been about 27 days. So 26 and a half days, and the median is about 17 days. So on average, there's about 20 days in a month. So this would fall perfectly in line with this September swoon narrative. We get a little bit of a sell-off, seasonally weak month, go back, sell off a little bit. Keep doing this. I don't know why. Go back to this 100-day, basically find some support and then carry on. If we pull up the NASDAQ one more time here, should we find a material sell-off, right? By the time that we did see it, it would just simply be a check back to this prior channel top that we saw in the NASDAQ. And then ultimately that would probably coincide with the 100-day. If it was aggressive in the NASDAQ and we saw a sell-off to the 100-day, essentially it would be the bottom of this channel, right? And then that's nothing. It's not calling for, a cataclysmic fall or anything like that. It's just telling us that we're getting a little bit of check back and then we keep it moving. On the next slide, we're going to see, pull it up. On the next slide, we've seen that history suggests, like I said, an average of 3% drawdown. The good news is every single time we find ourselves higher. We just went over that. The important thing to note is typically whenever we see these sell-offs, we'll find that people will come on television and, CNBC will put that markets in turmoil headline, yada, yada, yada. And then you'll hear people say, is this the big one, right? So the thing to remember here is this is something that we've been playing out since July. It's not anything that has changed materially on our end. And on the back of a weak jobs report that we just had and soft CPI, the global recovery narrative is going to get questioned. But unless something material comes out of this, and unless Delta and Lambda and all these other different variants of COVID become vaccination resistant, or we have an exogenous event that no one's really pricing in, or we have something material that's changed with the Fed, this is not an instance where something material will come of it, right? So this is all something that we talked about in the last video and the video before that, that whenever we get these kinds of sell-offs or whenever we get these kind of gut checks, people will call into question the recovery, and unless something material comes of it, it's typically a buying event. So the couple of things that I just really want to highlight here are there are, COVID. If COVID is vaccination resistant and it starts killing people, not people getting sick and getting better and moving on with their life, but if people start dying again, that's a really giant red flag. If the supply chain issues are severely disrupted, more so than they are currently, that's a giant red flag. And then the last one is if the Fed just kind of pulls their backstop, or some exogenous event that no one's considering right now kind of takes over, that's the time to reevaluate. But until then, it's going to be called into question. Markets in turmoil. You're going to see the graphics. And ultimately, these will probably be buying events. Now, on this next slide, again, it's just to reiterate, don't fight Jerome. Don't fight the Fed. People love to do this. I said in the last video, the number of times that you've seen your Uber driver bear tell you that this is the top for the last 7 years is unprecedented. That dude somehow is not broke because he's probably not trading it. But the number of times that you've seen that's how these people will post it online. They'll also try to spin every headline as a negative headline so they could tell you ultimately in the end, hey, I called the top. Top's not going to happen until this guy on your screen falls behind the eight ball significantly to the point where whatever action they take is de minimis, and or they pull the plug. So last week's jobs number and the soft CPI and everything that we've seen kind of reiterates that they're going to have to be, more on hold and more accommodative than originally expected. At least that's the narrative we're getting right now. Now, if they just decide, F it, we're just going to pull the plug anyways, that's a watch out time, right? But until that happens, this is kind of like what we're looking at. Now, the last thing I want to end with here is kind of like reiterating what it was that I said in the last video and most of last week. This is a good setup for, the end of the year. You first of all, you get a little bit of a kickback, and then the end of the year, you get that performance chase. The sell-off wasn't material, and, people will start to chase performance and look for mean reversions and look to meet their quotas and whatnot, right? So again, on the back of that, I don't want to be looking for the mega caps to lead. Again, the mega caps made up more than or about half the gains of the S&P in the last 3 months alone. So this is not where I want to look. I don't want to look to see if, Apple can rip another 7% to end of the year. That's just me. I'm more of look to see some of the names that have been beaten up kind of take off. So, I was giving examples last week, and this is just to show you and to reiterate how aggressive and how fast these moves happen. And the last video I put out was, right at this moment where Skills was taking off. This just shows you that when these moves or when these names that are beaten up back down to major support levels break out, and they have a large range in between their short-term moving averages and their long-term moving averages or mid-term moving averages, you get this aggressive kick higher, right? So these are, again, the same types of setups that I'm looking for. I'm looking for beaten up names. I'm looking for rotation into cyclicals, into recovery names, synchronized global recovery names. And then the last one is Japan just broke out of a huge range, right? So if I just go back, this shows you how wide it is. This is, the EWJ since inception At least I think since inception, because that's as far as back as it'll go on TradingView. But at the very least, this is a 24-year breakout, right? And so we're breaking out in Japan. This is a huge breakout. I'm going to make a video specifically about this because this is interesting. And there are some macro dynamics here that are interesting. But by and large, like, this is a huge breakout. This is a place that I'm looking on the back of this breakout. Again, I'll make a video about this. It'll be unique to and specific to Japanese names and what this could mean. But that's just one place I'm looking. Another place I'm looking is Deer. So for a while, you saw Deer and Caterpillar trade in lockstep. Right now, you're seeing, if I just pull up Caterpillar, you're seeing outperformance in Deer. It's pressing up against basically all-time highs again, and Caterpillar is starting to look weak. Walmart's another name. It's looking to break out of this, downtrend that it's been in since it announced. It basically pressed up against near all-time highs. Moving averages are getting constructive. It could rip again and push back to all-time highs. Another name I like is, and I mentioned this on the last one, is NetApp. If I just pull back, it's at all-time highs, breaking out of a 3-year basically consolidation. This is a very, very solid setup. A couple more. Pfizer, sold back off into support. Just trust me, sold back off into support, starting to find its footing. Again, if the 50-day can hold, if it can move up, I like that name. I like it to go retest and ultimately take out highs. J&J is another one, going back to a prior all-time high, holding support, 50 days acting supportive, and it bodes well. Other names, UNH, again, consolidating near all-time highs. Should it break out, could be a good one. And then I'm going to leave you with one small one, Metro Mile. This is another example. I'm going to show you Oscar because Oscar was in the last video. Here's an example of how fast these things can take off once they break these downtrends. So you have one major downtrend here. You have an exacerbated downtrend here. Soon as it recovers its 5 and 20 day and finds some sort of support, volume steps in, you get these massive squeezes higher. You get these are really small names, so you get these huge mean reversion trades higher. I'm looking for Oscar to go 20. So if I'm going to pull this back up to Mile, again, same exact kind of setup, right? You get this downtrend, get an exacerbated downtrend, pressed up against the 20 day. Should it take it out, could get a really, really quick, really vicious gap fill setup here. Let me just put a line so you can see it. Could get a gap fill situation here should it follow through. So these are the types of setups I'm looking for. I'm looking for these types of things to play out in the short term. From an index perspective, I'm looking for a little bit of a messy September or a sloshy September, whatever kind of comment you want to throw there. So that's kind of how I'm looking at it. That's kind of how I want to play things moving forward. I want to say thanks for checking me out again. As always, check me out on social media at EveryTimeICash. Reach out to me directly, everytimeicash.com/contact. Please leave a comment in the comment section below. Click the like button if you found it useful. Subscribe to the channel if you find it useful. It'll help me. Your feedback's helpful. Lets me know what's good, what's not, and I can hopefully help you along the way. So with that, I want to say thanks for checking me out again. As always, please stay safe. Please stay profitable and stay locked in.